Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of active versus passive investing. Which strategy fits your goals? When it comes to investing, one of the fundamental decisions that investors face is choosing between active and passive strategies. Active investing involves hands-on management of a portfolio, aiming to outperform the market by selecting individual investments. On the other hand, passive investing focuses on tracking a market index like the S&P 500 and typically has lower fees due to its hands-off approach. The decision between active and passive investing is crucial for investors as it can significantly impact their returns and overall investment strategy. Understanding the differences between these two approaches is key to making informed investment decisions that align with your financial goals and risk tolerance. By exploring the nuances of active and passive investing, investors can tailor their strategies to suit their individual needs and preferences. Understanding active and passive investing. Investing in the financial markets can seem like navigating a maze of choices. Two primary methods investors often consider are active and passive investing. Each approach has its own set of advantages and disadvantages, influencing how your investments grow over time. Pros and cons of active investing. Pros of active investing. Active investing involves hands-on management of your investments, typically by a fund manager or yourself. One of the key benefits of active investing is the potential for higher returns. By actively buying and selling investments based on research and market conditions, there is a chance to outperform the market. Flexibility and decision-making is another advantage. Active investors have the freedom to adjust their portfolios quickly in response to market changes or new opportunities. Cons of active investing. However, active investing comes with higher costs compared to passive strategies. Constant monitoring, research and trading can lead to increased fees that eat into your returns over time. Another drawback is the risk of underperforming the market. Despite efforts to outsmart the market, not all active investors succeed in beating the benchmarks consistently. Pros and cons of passive investing. Pros of passive investing. Passive investing, on the other hand, is a more hands-off approach that aims to replicate the performance of a specific market index. One of the primary advantages is the lower fees associated with passive funds. Since passive funds require less frequent trading and research, they tend to have lower expense ratios. Passive investing also typically results in reduced portfolio turnover. This can lead to potential tax advantages and lower transaction costs compared to active strategies. Cons of passive investing. While passive investing offers simplicity and lower costs, it lacks the flexibility of active investing. Passive investors are tied to the performance of the market index they are tracking and may miss out on opportunities to outperform. Additionally, by mirroring the market, passive investors could potentially miss out on investments that perform exceptionally well but are not included in the chosen index. By understanding the pros and cons of both active and passive investing, investors can make informed decisions that align with their financial goals and risk tolerance. Whether you prefer the active pursuit of market-beating returns or the hands-off approach of tracking market performance, choosing the right investment strategy is a crucial step in building a successful portfolio. Factors to consider when choosing between active and passive investing. When it comes to deciding between active and passive investing strategies, there are several key factors that investors need to carefully evaluate before making a decision that aligns with their financial goals. Understanding the nuances of risk management, diversification, performance analysis, historical data interpretation, and other considerations can significantly impact the success of an investment approach. Risk management and diversification. Risk management and diversification are crucial elements to consider when choosing between active and passive investing. In active investing, where fund managers make individual investment decisions in an attempt to outperform the market, there is a higher level of risk involved. On the other hand, passive investing, which involves tracking a market index, typically offers more diversification and lower risk exposure. For example, in active investing, an investor may select specific stocks based on market trends or company performance, which can lead to higher returns, but also higher risks if the market moves unfavorably. In contrast, passive investing through index funds spreads the investment across a broad range of assets, reducing the impact of individual stock performance on the overall portfolio. Performance analysis and historical data. Analyzing performance metrics and historical data is essential for evaluating the effectiveness of both active and passive investment strategies. Investors need to pay attention to factors such as return on investment, volatility, and correlation with the market to assess how a particular approach has performed over time. When looking at historical data, investors should consider factors like the fund's performance in various market conditions, consistency in delivering returns, and any fees or expenses associated with the investment. By interpreting this data effectively, investors can make informed decisions on whether an active or passive strategy aligns better with their investment goals and risk tolerance. In conclusion, understanding the role of risk management, diversification, performance analysis, and historical data interpretation is crucial when evaluating the choice between active and passive investing strategies. By considering these factors along with personal risk tolerance, time commitment, market conditions, and cost effectiveness, investors can make well-informed decisions to build a successful investment portfolio. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.